Good afternoon. We are back for Tea Time Tips. So today is session 2 of Tea Time Tips. What Tea Time Tips is about is teaching you small bite-sized bits of information. So rather than a lunch and learn, which typically goes for an hour or so, these are suitable for a tea break. So you can grab your cup of tea and join me for Tea Time Tips. So they're sort of 15-minute type sessions on a variety of topics that I think will be of interest to people out there. The first couple of topics have come about because of things that have been happening in my world and things that I've been seeing, but more than happy to cover anything that you have going on in your world. So if there's any issues you want me to cover in Tea Time Tips, then please feel free. So today what we're going to talk about is risk and insurance. I know it sounds like a bit of a dry topic, but it's actually really important that we cover these type of topics off rather than just the more exciting stuff as well. So today it is, as I said, risk and insurance. So let's get kicked off. This topic does cover things for everybody. So it is for individuals as well as businesses. More geared at small business, but definitely applies to everybody. What is risk, and is it always a bad thing? So if we look at the definition of risk, then you'd say that, yeah, risk is a bad thing. So risk is the possibility of something bad happening at some time in the future, a situation that could be dangerous or have a bad result. So we look at just a couple of key parts of that. Possibility. So it's not definitely going to happen or not definitely going to happen in a set time frame. So there's uncertainty around risk. And that's what comes into the pricing of risk later that we're going to talk about, because it is the uncertainty that makes it cost money. And it's also about that could be dangerous, could have a bad result. It doesn't mean it necessarily has to have a bad result. It also could be a person or a thing that is likely to cause problems or danger at some time in the future. So for instance, we can say, oh, that person's going to be a risk if we hire them because we think that they're going to do something questionable later. Okay, so we can talk about a person or a thing. And then the last one is a good or bad, poor risk, a person or business that a bank or an insurance company is willing or unwilling to lend money to. So a bank will talk about someone being a poor credit risk. It means that they don't think they're going to get their money back, which is obviously not a situation that you want to be in. Risk isn't all bad though. So those just, the terminology sounds a bit negative, but do remember this: if there's no risk, there is no return, which is important to remember. There is also that, remember, if you've never done something before, the risk of failure is high. And remember last week we talked about failure being the first attempt in learning. So for instance, if people didn't take a gamble, they didn't take a risk, then we wouldn't have what we have today. We wouldn't have computers and lighting and technology and planes and cars. We wouldn't have all those things. We'd still be cavemen, rubbing sticks together to create fire. So risk has to happen for us to grow. So we need to take a chance to make big changes in our lives and in the world. But it's important to take calculated risks. And you might wonder, well, I've got a picture of a beach, but I figured I'd just show you an example here. If we're building a sandcastle, okay, and we put a sandcastle right here, now we can clearly see the water line is going up here. So maybe the water's receding. But if we build our sandcastle right against the water's edge, what's going to happen? It's obviously a poor risk decision because our sandcastle is going to be wiped away with one rogue wave coming along. So we need to take calculated risks. So how do we do that? How do we manage our risks? Risk management is the forecasting and evaluation of financial risks together with the identification of procedures to avoid or minimize their impact. Now, for those of you that don't know my background, my very first job out of uni, after working at Macca's in uni, was at Westpac Financial Markets in New Zealand. And my very first job was analyst operational risk control. And that's all we did was risk management assessments. And one of the very first jobs I did in that was a business continuity plan. For those that understand Wellington, you'll know that Wellington is a major earthquake zone. So a business continuity plan obviously include plans for Wellington is wiped out, the dealing room is wiped out, a particular system is wiped out. So there was business continuity as well as disaster recovery. And we had to use the plans twice because there was a situation where the dealing system went down one morning and we had to basically minimize the impact to the rest of the business and try and restore, effectively understanding what our global balance sheet position was, which was kind of scary at the time. So that was a challenging one. The other one that we had was that the Auckland dealing room was shut down. New Zealand went through a very third world phase of Auckland having no power. So Auckland CBD for months on end basically had no power because the major lines that were contributing power to the city, one of them had been cut, another one was compromised. It was a disaster. So we had to move the Auckland dealing room down to Wellington. So that is, what risk management is dealing with. It's looking at those issues, those potential issues in advance and saying, hey, we could lose power. What do we do when we lose power? What happens if our, website goes down? What can we do about it? So that is all about risk management. So how do we go about risk assessment and risk management? In a risk assessment, what we're doing first of all is identifying what risks might apply. So they're operational, they're financial, they're reputational. It's not just the numbers. It is about the impact it has on our business from other perspectives. We identify what those risks or the hazards are. We then assess that risk, and then we work to control it. So we either choose to accept it, because like I said, you've got to make some acceptance of risk going forward. We can reduce or mitigate it, which is what we mean by that is we can put processes in place to try and reduce the chance of something happening. So for instance, in a workplace, we have hazard identification and things. We make sure that people aren't going to trip over hazards in the workplace, have slips and falls. So, at McDonald's, we had to, check the surface of the tiles in the kitchen area to make sure that they weren't going to get all greasy and slippery, because obviously more chance of someone falling, landing on a grill or something like that. The eliminate is when you're absolutely saying that risk is, we cannot accept it at all. We will get rid of it completely. So we will not do that activity. We will not operate in that location. So there's things that you can do to completely eliminate the risk. But most of the time, we're going to be reducing or mitigating the risk. And then we can go through a bit of a review cycle. So identifying your hazards and your risks. What you need to do is look at all the activities. And like I said, this could be a personal thing or it can be a business thing. So looking at all your activities that you complete, there's a chance of injury occurring in anything you do. So things like slips and falls, people carrying things around, all of those increase the chance of injury. So we need to make sure that we are, as business owners, aware of them, but also as employees aware of them as well. There's a chance of reputational risk, and that can be to ourselves if we are, for instance, if you apply for a job and you pretend, I've got all the skills, mate, I can do that. And then you go to the job and you do a terrible job because you had no idea what you were doing. Your reputation is now damaged. People are going to say, oh my gosh, you're a terrible worker. They're going to assign that to you as a person. And it's not you as a person, it was your doing certain tasks. But you told them that you could do those tasks. So you're kind of asking for it, right? So we just got to be careful there. Then we've got the repetitive tasks, the OOS stuff. So if you're doing something over and over again, if one of your employees is, then making sure that we're not putting ourselves in a position of getting repetitive strain injuries. Trips and hazards and things. If you lose your job, you could lose your income. So that is a risk if you are reliant on that income for your family to be fed, for your mortgage to be paid. Droughts, that picture is obviously a picture of last year when things were very bad. So droughts are when can cause lost income for a farmer, but they can cause flow-on effects to everybody. We all know that after the 2020 droughts in Australia, that, prices of fruit and veggies just went through the roof because a lot of it had been destroyed. There's also reputational risk. So if there's a bad customer experience, someone has a bad time, they may go out and put a bad review on socials. They may go to a current affair or whatever and put it out to the world. So that is going to have potentially a massive reputational risk, which will have potentially a flow-on risk as well. We just got to be aware of all these issues. With work-related stuff, you can refer to Safe Work if you're in Australia or WorkSafe in New Zealand to help give you some guidance into how to identify those hazards and risks in your workplace. So what you should do is complete a risk assessment. Now, the last thing I did before I left NAB about 6 years ago was actually a risk assessment process. So we literally had to go and identify all the potential risk areas in our business, and we had to rate them on a scale. And so what I've suggested here is that you can do it through a chart like this one. So this chart here is basically saying if something has a very low likelihood of occurring and it has low impact, so the reputation, the cash flow, the viability, the financial impact is quite small, then we might just choose to accept it. And that's why it's nice and bright green, like a traffic light, right? We can choose to accept it and go, sweet, cool, no problems. On the top side here, the red is that we must eliminate it or reduce it or mitigate it, because this is a very high likelihood of happening and a very high impact if it occurs. Now, for instance, the flooding in the Hawkesbury recently, the likelihood of that occurring was high. You know, it's scheduled to happen regularly. It was a high chance that they were going to get flooded. And there's a high impact when they get flooded. They are literally losing hundreds of thousands of dollars worth of damage to their homes and their properties. So the thing is, you've got to eliminate it, reduce it, or mitigate it. And what a lot of people did was they cried, I don't have insurance. It's like, okay, there was a reason why your insurance was $20,000, because you're basically, it's almost a certainty that you're going to have a claim. But it's not a certainty it's going to be a claim that year, which is why it's not, you know, the cost of the house or the cost of the repairs. But for instance, if I say to you, I'm going to give you $100, I'm definitely 100% going to give you $100, then you potentially might give me $100, and then I will give it back to you. But if, however, there's any doubt that I may not give you that $100, you're not going to give me $100 for it. You're going to give me $97. You're going to give me $90. You're going to give me $50. So the whole idea is that risk and uncertainty affects what something is worth. So obviously flood insurance is very expensive in an area like the Hawkesbury, because the chance of it happening is incredibly high with a massively high impact. So, you know, we're talking it's got to be in the red or orange zone. So we say the likelihood, maybe you say in a year, might only be medium, but the impact of it's high. So it basically is going to sit in that little orange box there. What we need to do with our businesses, but also with our lives, like I said, for a house, you know, do I take out house insurance? Do I take out that flood insurance? Okay, it's going to cost me 20 grand to do it, or it's going to cost me 10 grand to do it. What happens if I don't do it? Well, if I don't do it, I'm not insured. Okay, well, maybe I can put some money aside instead. But you need to understand what your risks are. So this is a way of doing it. You do low, medium, high impact. And what you basically do is just plug in your things here. So you put a little cross here and say that's, you know, number A, and you write down the bottom what number A refers to. Or you just put it in a spreadsheet. And you can always watch these on the replay as well. And I will also put, because I'm recording these off BeLive, I can download them and also put them up on YouTube, which is what I will be doing. Managing your overall risk for a business, one of the things that we can do is do a bit of a SWOT assessment on it, particularly focused obviously on threats. And we can do an overall risk assessment using something like that matrix on the previous page. We can also do things like create a business continuity plan or a BCP. So for instance, Melbourne, feel for you so badly. Melbourne back in lockdown again for another 7 days due to COVID outbreaks. So unfortunately for them, they're back into this. Now, obviously for them, many of these companies now 100% have business continuity plans in place. They know exactly what needs to happen to have their business still running tomorrow, because they are full set up to, you know, work from home and all that stuff. But we roll back a year and a bit ago, people were not set up to work from home and things. A lot of people are more prepared now, particularly in Melbourne, but there's still a lot more we can do. So the difference between a business continuity plan and a disaster recovery plan, a BCP or business continuity plan is keeping all aspects of the business running with very minimal disruption. That's the purpose of it. Whereas the difference with a disaster recovery plan, that's like, for instance, when your warehouse burns to the ground and you've literally got to start again from scratch. A disaster recovery plan is about recovering your business to its former levels or to new levels, whatever you've decided they're going to be after something's happened. So it's restoring your business or life in the event of that outage. In New Zealand, like I said, we had a lot of earthquakes and things. And so we were making sure that you had both the BCP and the DRP, because obviously there could have been an earthquake which wiped everything out. But as much as possible, you needed your business to keep going in the interim. If you're an individual, or even for businesses as well, what you can also do is look at these type of things. So insurance won't stop the hazard or risk occurring. The thing is still going to happen. But if it does happen, you do get some financial relief because you get some money back from your insurer. So again, the flooding situation. If you pay for the insurance cost, yep, you might have paid 20 grand, 11 grand, but you're going to get your $200,000 to rebuild your house. You can also put into place contracts, agreements, or procedures to make sure that you minimize the likelihood of that issue occurring again. So for instance, with contracts, you can set up a contract with your customers and make sure that it's crystal clear in the contract what happens in certain situations. So that should minimize the risk of somebody, doing the wrong thing just because they're grumpy and upset. You want them to come to you first. And then the last one there is prevention. So doing things like vaccines, doing ergonomic working, having a clean office space so that you're avoiding trips and things. All of those things will help with prevention. So the last thing I want to talk about is insurance. So what are insurances? So insurance is basically just a risk mitigation tool. That's all it is. So insurance is an arrangement by which a company or the state undertakes to provide a guarantee of compensation for specified loss, damage, illness, or death in return for a payment of a specified premium. It can also be a thing providing protection against a possible eventuality. So the thing with insurance, obviously, if it's likely to happen, the cost is going to go up. So for instance, if you take out professional indemnity insurance and you're just telling people all the wrong stuff and you're doing all sorts of things, there's a high chance you're going to have a claim against you. Or if you work in a certain industry where claims are high, then there's a high chance of something happening. Therefore, your costs are higher. So what you've got to do is work out, where you fit. So what type of insurance can you have? There's all sorts of, general insurance like floods and fire and theft and earthquakes and things like that. There's also obviously your health insurance, your disability, your death. So some of those can be through your superannuation. Just make sure you're checking your super insurance costs and whether or not they're actually worthwhile getting in your super, or whether you should maybe look at getting them through a private insurer. The assets and stuff, the reason I said assets and stuff is because most people do not class a car as an asset. They are usually depreciating in value very much unless they are Suzuki's, and then for some reason they seem to be going up in value. Your home, your car, your contents, all those sort of things can be covered. And there's different levels of coverage. Obviously things like full replacement, a comprehensive type plan, or just a third party. So if you hit somebody with your car, it's not going to cover your car, but it will cover their car. So you can work out what you want to do. So business insurance, there's a lot of different businesses insurances out there. So things like public liability, professional indemnity, business interruption, cyber insurance, directors and executives and officers, which is why for businesses particularly, I do recommend you go through a broker, because you may not be aware of all the things that are out there for you and what could potentially give you some coverage. Common insurance issues that you might face. Number one is the high cost. Like I said, the Hawkesbury scenario. If you're going to live in the Hawkesbury and you're going to live on a floodplain, then you've got to make a call. Do I want to get insured for floods? Because the chance of it, you needing to get a payout is very high. But don't go crying and saying, I haven't got insurance, it was too expensive. Either move or take out the insurance, because there's a reason it was so expensive. It was because the chance was so high it was going to happen. These numbers aren't plucked out of thin air. There's a lot of assessment work that goes on behind the scenes to calculate risk insurance levels. And so, there is a reason for them. Be very careful of the fine print in your insurance contracts, okay? So I know some of these documents are huge. This particular one here that I'm referring to in this example, those documents were 200 pages long, huge document, but you have got to actually skim through it at least check out the headings and things, and particularly look at what's not included. So for a start, there's always inclusions for things like illegal activities. Now, this is the one that I'm sort of pointing out to you, because there is a massive issue with this one for a lot of small businesses. A lot of small businesses think that they can just operate from home or just operate from any business premises where they feel like it. You can't. And if you do not have zoning for your business, you can find that you are technically running an illegal activity. So if your activity needs to be DA approved by council for the use, you have to have that. Otherwise, you are operating an illegal activity. And that is pretty much in every insurance contract an instant out. So bear that in mind. There's no point paying insurance premiums for something that they will then turn around and say, sorry, you're not insured. There's also another issue for lack of notification. So if you don't tell them that you have, for instance, damage to your car, then they can say, sorry, that damage to that car contributed to that accident, and therefore we're not paying. So please make sure that you check your insurance terms and make sure that they are covered. Really, really, really important. The other issue is that global issues have a massive impact on the reinsurance market. So obviously local issues definitely do. So if you're in the Hawkesbury and try and get flood insurance right now, yep, you're going to find they've probably gone up again, because the 1 in 100-year floods, the 1 in 50-year floods, the 1 in 20-year floods seem to happen more often than they're meant to. The market locally is going to go up, but obviously the market globally is going up as well. If there are firestorms in LA, if there are landslides in India, if there is COVID stuff everywhere, that has an impact on the global reinsurance market. So what happens is your local insurer typically goes to a global reinsurer to insure the risk. So the whole idea is they're collecting money from all around the world on different things, and they offset each other. So if there's storm damage is high in one area, they're hoping kind of earthquakes not high in the other area. When they all hit at once, that's when, unfortunately, premiums tend to rise very quickly. So I mentioned this before, but self-insurance versus no insurance, just understand these are two different things. You can have no insurance, which means you have no cover and no bleating, please. If you choose not to have cover, you choose not to have cover. That is your choice. Okay, that was your risk assessment. You decided to run the gauntlet and not, take that on. That's your problem. But if you choose to do self-insurance, what that basically says, instead of putting $20,000 and paying that to a insurer to cover your house, what you do is you basically stick that 20 grand in an account and you stick it aside. And that money is your self-insurance. So basically, if something happens and you get flooded, you dip into your self-insurance money. Now, obviously, if you've paid in there for 5 years, 20 grand, then you're going to have 100 grand in there, which is going to, do a decent amount towards your self-insurance. It's not going to cover everything, because the difference with insurance is if you've only paid, $5,000 in premiums and the cost is $250,000, well, you get $250,000 worth of benefit. But that's why you're paying more to be insured with them. And like I said, they're spreading the risk out. It's not one person's risk. It's 20 people's risk, 100 people's risk. Obtaining insurance, brokers are there. They're often tied to set insurers, and they may not be tied to the same set of insurers, which I found interesting. So I use Steadfast Intercharge, and a couple of years ago, I was looking to checking my quotes, because I had kind of just left it with them for a few years. So it's always good to check every couple of years, every 2 or 3 years, with a multiple scenario. In between, I left it with them for a couple of years, because that's fine. I don't want them to have to do this massive amount of work and get nothing out of it, or little out of it. So what I did is I did go out to people and other Steadfast operators and say, oh no, we can offer an alternative that may not be the same panel of brokers that the one that I was using were using. So I found that quite interesting. So the brokers do have different insurers. So don't just go to one broker, actually go to a couple of different brokers, 2 or 3, and get different quotes. Like I said, don't do it every year, but I would do it every 2 or 3 years. Check very carefully what is included. My renewal that just happened was very complex, because I do a lot of different things, and trying to get everything insured was just chaos. But anyway, we got there in the end. So just make sure that everything is covered, that you're not having things left out that would cause you any issues. And if your business is complex, do not go cookie cutter. You can't just go and get something from a random or go to BizCover or whatever and say, right, I'll have that type of insurance, because you're more than likely not going to get the right thing. So go to a broker and make sure it's designed for you. There are some other complications with insurance. And one I would like to highlight is that if you change your activities, if you change the number of employees you have, if you start contracting some stuff, if you add territories, especially the US and Canada. This is something I just want to really flag, because I've got a lot of customers at the moment looking at doing online courses and things, which is awesome. Love to help them out with that. But, and there is a big but here, the insurance costs can go up markedly. So one of my clients, for instance, he was paying $250 for his insurance. He should have been paying $400 because he realized he was underinsured when he sort of went through this exercise. But he then realized that to go and do online courses, which included North America, US and Canada, he was going to be forking out 10 grand. So it was going to go from $400 to $10,000. That's a massive difference. So obviously you've got to factor that into your costs. Just be very careful when you're obtaining insurance. And one other little aside there for something that can work in your favor is industry associations. So I did say don't go cookie cutter, but if you are in one particular field, so if you're a kinesiologist, you can go to the Kinesiologist Association and see what they offer. And a great example of this was the Australian Tutoring Association, ATA. One of my clients came to me and she said she'd got a quote for professional indemnity and public liability for $2,500. And she wanted to know whether she actually even needed professional indemnity, because she's going, I'm a tutor, I'm not really sure that I need it. And I said, well, why don't we just look on one of the tutoring association sites and see what they say? Because quite often they will have some deal with insurers or whatever. So we looked on there, and what we found was that for about a $299 membership fee and then another $300 from the insurance, so like $599, I think it was total, she could be a member of the association for a year and have exactly the same coverage that she was quoted with Aon, who's a very top insurer, and it was going to cost her $599 for a year instead of $2,500. So definitely, if you are a member of a particular industry, then do look at your industry associations. They do sometimes have really good deals, and sometimes it's even part of the membership. So just do that. That is what I'm suggesting you do today, is look at your risks, identify your risks, and work out what you should cover. So what things do you need to, through your assessment, do you need to control? Do you need to take an insurance? Do you need to improve your contracts or your procedures so that you minimize the risk of issue occurring? Really look about continuous improvement. And if you need help, feel free to reach out. So for those that don't know me, I am a Business Connect advisor with the New South Wales government funded program. So you may be able to get some funded help through that program. I also have my online business school coming up, so keep an eye out for that, and the courses will be on there about topics like this. I also offer group training for businesses, networking groups, conferences, and teams. Reach out if that's of use to you, or you can get one-on-one assistance from me through my coaching or advisory services. Thank you for coming along today. This is an example of a tea time tip. Clearly, I rambled for too long today. I'll make sure I do them a bit shorter in the future. Always hard for me, but I'll keep it shorter and just make it a bit more to the point. But what I want you to do is to let me know if there's any particular topics you want covered in Tea Time Tips. So the idea is that you can come along with a cup of tea or whatever, take a bit of a break from your day and join in and hopefully have a bit of a discussion. So some, like you said today, this was more just because it came about recently with my renewal that I realized how much of an issue it was at the moment renewing your insurance, but also because I kind of got frustrated hearing these randoms complaining about the cost of insurance in the Hawkesbury. And I'm like, I'm sorry, but it's a risk you took on by living there. So, you know, it's like my beach house in New Zealand at Riversdale. My beach house is not on the beachfront, because I know it's got coastal erosion. I know it's got more tsunami risk, so I'm inland. That's my choice. You know, that comes back to calculated risks. Please think about that in your own businesses and in your own lives, that you've got to take some accountability and responsibility for your own actions. Please feel free to leave any comments down below. Feel free to send me a message behind the scenes or whatever and get in touch. But I hope that was of some use today to help you to manage your risk and insurance. Catch you later, and we'll see you again next week for another tea time tip. Probably do a marketing one next week. So we'll look at something for targeted at business owners. Okay, catch you later. Bye-bye.